And so now you find yourself educating, especially you talked about IRA investors, right? And our investors are happy to get 5.5% right now, right? And they're like, ooh, yeah, they're your favorite, and you're like, oh, no, we can get you more. We can get you more than that. And they're like, really? Wow, that's amazing. Tell me more about that. Well, welcome everyone to our interview with John and Sandy. We're talking about how we're buying apartment buildings in 2024 because I've heard literally for the last 8 years since 2014, it's almost impossible to get deals done. And it's always for different reasons. Back in the day, it was, oh my gosh, the market is so hot and I can't get a deal done, right? There's all these deals on the market and I can't win any one of them. Now it's like, well, shoot, no one's selling, no one's bidding, I can't get a deal done. So magically, somehow, people get deals done. They've been doing it since 2014, since we started the podcast and advising people how to actually get deals done. And today we have two of our students, actually, John and Sandy, who are going to share with us their experience from getting a deal closed. And I think you're going to find it real valuable. It's a really deep dive case study. So what you're going to learn today is what to look for in a live deal. Like some people are saying, I can't find deals, nothing pencils, oh my gosh. And then obviously how to avoid the pitfalls and the mistakes. And what's the process like? We're really going to drill down on that here. And if you're not familiar with my name is Michael Blanc. I am the host of the podcast Financial Freedom with Real Estate Investing. I'm also the author of the book by the same name. They're both yellow and they have the same name. So check it out. If you haven't already, check out the podcast as you're listening to it right now or watching YouTube, and check out the book on Amazon as well. And also, we own about $350 million in real estate ourselves. But what I'm most proud of is that we've helped hundreds of people do their first apartment building deal and quit their job. And really, that's what we're here about to talk about today, is how do you scale your real estate portfolio? Maybe you've done some real estate transactions, you've flipped a house, or you've maybe have some rental property, you're trying to scale, and you're like, oh my gosh, I can't scale this. How do I scale this? The answer is apartment buildings. And it's actually surprisingly easier than you think. And you can break into this business without the experience necessarily. And you don't have all the money raised because you need sometimes hundreds of thousands of dollars to raise the money. And you're going to raise that from other people. And that's what we're going to talk about today here. So our two guests here today are Sandy Bondurant. And she's got 20 plus experience in sales, business marketing, investor relations, property management, project management. And the thing you're going to find for people who have never done a deal before is they do have track record. It's just not directly related to apartment buildings, but you can parlay your professional experience into this as well. And she's actually, she hosts a daily morning mindset motivation podcast herself. And that is really awesome that Sandy is not only becoming successful, but helping other people as well. And one of her partners is John Vanderbuck. And he's got a BS in science and tech at Pittsburgh State University. He's super smart. Okay, he started up a tech firm, and he was in oil and gas business as well. He was an EVP of sales and marketing at an early age. But he did begin his real estate journey in 2017 and still holds a real estate license. And like so many of us, we get started with single-family houses, and we realize we can't scale it, and somehow the light bulb goes off, and we pivot into apartments. So with that, I'm going to turn it over to John. John, I want you to introduce your deal, and let's go really deep into that deal and tell people how you found it, how you financed it, how you got it done. That's what we want to know. We all want to do our first deal, John. Take it away.
Yeah, thanks, Michael. I really appreciate it. Like Michael said, my name's John Funderburk. I'm originally from South Central Kansas. I started in real estate in 2017. So this is the deal that we actually closed on today. So such a timely podcast.
You closed on it today. Well, that is fantastic.
We wired the money and got the keys today. So man. This has been scheduled for a while. We got over some humps, but yeah, we closed on it today. But like you said, I started in real estate in 2017. Started exactly like most people do in single family, doing flips, buy and hold. I have a small portfolio myself, and then got into ground up construction in single family and just went from there into multifamily. So just like you said, joined your network, and just kind of grew from there. So that's that. And Sandy, my business partner, and everybody else on the team, really it's about the entire core team that put this deal together. It's not certainly just not us two, but it's the whole team that put this deal together from sourcing and capital raising and underwriting and everything. It's the entire team that put this together, and the experience went a long way for that. So with that, I'm actually going to turn it over to Sandy and let her go through our investor presentation.
Awesome. Thanks, John. So happy to be here. And I just like to put this out there for everybody because I want you to know that this is truly doable. There's really nothing special about John and I or our team, other than the fact that we were willing to basically get the mentorship, take the steps, and then take some action. And looking at the chat with some of the comments that I'm seeing in there, raising equity, putting a team together, we had those same exact road bumps too. So know that it's normal and you're going to experience it. That's part of the growth. But it happens. I'm a single mom. I worked a full-time W-2 for 20 years in psychiatric pharmaceutical sales, and now I'm doing this full-time. So if you stick to the plan, take the action, I promise you it's doable and it will happen. So this is Chesney Woods Apartments. This is what we actually closed today after quite some time. So this has been a project. But 48 units. The cool thing about this deal, it was never on market. So this speaks to the fact of making those broker calls. This was acquired through one of our GPs, our partner, Ryan Carter, and a broker relationship that he had. So the sellers were tired, looking to get rid of it. We went ahead, did the underwriting, made the numbers worked. And so it was great. So I will say, make sure that you're making those broker calls and connecting. This is, we always do this disclaimer, of course, real estate investments are just that, real estate investments. There's always risk with that. We did promote this as a 506B, so it wasn't publicly advertised for our raise. We paid 6.1 for it, so our raise was right at 2.4 million that we had to come up with in private equity. John and I, as far as our roles in the GP, was raising that capital and investor relations. But really in this deal deck, and I encourage you to kind of put yours together the same way. We hit the highlights. I'll tell you a little about our team, our track record, why we like Chesney Woods, our business plan, and the market and comps, and then kind of how to get involved. And that's really as simple as it is. I think investors just want to know what's great about the product. If what they give you, what are they going to get it back, and when are they going to get it back? So let's go ahead and go to the next slide. The highlights here, why we like this. Obviously, we're all looking for markets where you're having job growth, you're having rent growth, you're having income growth. But if you can also look for additional areas that make barrier to entry a little harder, this area specifically, looking at our exit 5 years ahead, so we're always looking at our exit when we're going into a deal, we know that water and sewer is at capacity in this area. So there will be no new construction that's going to be approved through zoning for at least the next 5 years. So that puts us at a great advantage as far as occupancy goes. And this asset is already 100% occupied. We had one vacant that was used as a leasing office, which will be turning into a residential unit starting tomorrow. But B location in an A neighborhood, it's within a couple miles of a major freeway. It's 15 minutes from uptown Charlotte. Higher income as far as household median income, over 107,000. Unemployment is low. And these are great 2-bedroom townhome style apartments. Cool thing about this place is that it also sits on 10 acres. So the 48 units front and back are all like wooded views. It's like a little village. So that's pretty great. So those were a lot of the things that really attracted us to this property to begin with. And then about our team. So our team is pretty much all from the Michael Blanc network. Like this network, and I have been a part of several masterminds. I'm a big believer in mentorship and paying for the education, but more so I believe in paying to be in the rooms with the right people. And that's really what I believe you get from the program. Kyle serving as our key principal. He served on several other deals within the Michael Blanc program. And then John, of course, and you've met myself. And then our guys, Brock, Ryan, and Bill, also in the DMM program. Veterans, 20 plus years experience in the Army. Bill's a West Point grad. Brock, special ops. Ryan, history in new construction, general contracting, project management. He's an acquisitions manager for a Fortune 500 company in asphalt. So these are guys that are very attuned to the details. They pay attention. I couldn't ask for better asset managers. Acquisitions, they're underwriting. So all three of them are looking at it. They're stress testing. They're stress testing each other on it as well. So it's a great group, and they certainly bring strengths that John and I, that's not our cup of tea. That's not what we enjoy doing. So it's great to have these guys. And then John and I were talkers. We love talking to people about how we can make money doing this. So it works out pretty great to do that. So that's a little bit about us. As you'll know, like property management can make or break a deal. And we found that it's best to interview several of them. And of course, after you interview them, dig a little deeper. We actually went and toured the properties that they were managing. We wanted to know, like, what did it actually look like? What kind of ship were they running? And then we took it a step further to find out what their resident retention looked like. So are they getting 5-star Google reviews? Are their residents renewing leases? Are they maintaining a high occupancy? We went with Allison because she met all those metrics, and she has similar assets within a 10-mile radius that she went through the stabilization process on. And her business plan around adding other income was great. She's been successful at it. So those were some of the reasons that that we brought her on, and we're super excited about having her. And then track record. So this is really important to us. Like, what did we promise investors and what have we delivered? And as a team, we've been able to show that in our projections, IRR 16%, but we've actually delivered over 24%. So these are things that, as you put your teams together, you'll have these type of things that you can put into your deal deck. And I think it puts your investors a little at ease. Thompson Place actually was just purchased in September 2023 and wasn't due to start distributions to the investors until 6 months post-close, but they actually started early because of the cash flow. So I think that's another thing that we like to talk to is, how do we treat our investors? What does that look like? And what have the distributions been? How soon have we made those? Typically on this deal and our next deal that we're under contract on now, we're looking at doing distributions 6 months post-close. So and then quarterly beyond that. And here's the actual property. So as far as the property, acquiring it at 6.1, the cool thing about this is it's a value add in the fact that the market rents are about 250 below market value right now. So 48 units, knowing that we can push the rents that much just to get to market is a great thing. As far as occupancy, like I mentioned, there's no new construction in the area and there's a need for housing. This is in an area where there's hospital systems, shopping, university. Charlotte area is big for NASCAR racing, sports arena. So there's a lot going on in this area. Like I said, it's in an A area, B neighborhood. And the unit types, like they're all townhome style apartments. They all have private patios. It's very unique in that way as well. And it's 8 buildings sitting on 10 acres. So looking at the interior, not too much of a heavy. What we were looking at as far as our business plan is updating some appliances, light fixtures, paint as needed. We'll be doing some new carpet and going throughout, any knobs, replacing with nickel, etc. So that's kind of the interior plan. And then another big thing that we looked at, and we'll be doing this as we can on our assets moving forward, is the other income. So as we bring in new leases or leases turnover, we'll be implementing internet amenity package that includes internet, cable. So it'll be a bulk fee, and then that'll be billed to the tenants. $50 of that will go back per unit to the net operating income. They all have washer dryer connections. So this is a great thing that we can do. We charge the tenants $45 a month. A portion of that goes back for each unit. And then implementing valet trash, landscaping, admin fees. We have some pets, but pet fees aren't being enforced. So making sure that we're running it the best that we can there as well. And then making sure that we're going to kind of phase this over our business plan. So by the end of year 2, we should have our business plan fully executed. This was really cool. Like I told you, if you can see those 8 buildings kind of in a rectangular form, sitting on 10 acres, there is some land in the back that is a development opportunity. It's not something we're probably going to explore. But again, thinking of our exit, it is an opportunity for the next buyer to come in and actually add some additional units, some storage spaces, dog parks, amenities, etc. So another thing that just attracted us to the value add on this. Um, Looking at bonus depreciation. And this is cool, especially us all knowing that it is on the table to bring in the 100% bonus depreciation to bring that back. But for right now, knowing that this year alone, we can take advantage of a 60% bonus depreciation. That's been great for our cash investors, knowing that 15 to 30% of their cash flow, they're essentially not going to have to report when they receive their K1. So it's all about just keeping more of the cash flow that you're bringing in. And then when we were looking at acquiring this, so we had the option to assume a loan that they had in place. Seemed attractive at first. However, it wouldn't have allowed us to exit the deal any sooner than 6 years, just because of the prepayment penalties being high. It didn't make the cash flow work for our investors. We actually looked at new agency financing, which is what we ultimately ended up doing. We can exit as early as year 3, but we did it as a 5-year plan. And that put us at an average annual return at 23.5%. So that was great. Our investors love that. The cash on cash, a little over 6%. As far as the split, I think someone asked that. It's an 80-20 split. So that's kind of how we believe in doing ours. The big thing is a 2x multiplier. So at sell, whether we sell year 3 or year 5, you should expect to have a 2.2 equity multiplier. The rate on the new agency, I see that question, is at 6.4%. And then our financial projections. So if you remember, I told you that the current average rents right now, they're $1,130. That's $250 below just market rents. So we're excited about this because our projections, looking at what we projected at the end of year 1, was only a $51 increase. At year 2, $53. Year 3, $55. Year 4, $57. So the max increase that we're accounting for in our profit and loss, so our pro forma, is $60. But we already know, right? So I expect nothing less than us to overperform based on how conservative we were on our rent projections. And then looking at our other income, knowing that we're at 100% occupancy, we still accounted for 8 to 7% on vacancy. We still included our concessions. So all the things we learn when we're doing our SDA, I think are really important, because what's going to happen is, I think the reason that we've overperformed as a team on previous deals is we've been very, very conservative in our projections. And that's just,
and I would just to add to this. This is when I first came into the team. One of the things that the group really allowed all of us to do is get together and huddle and talk about these numbers and talk about how we put this together with the SDA, regardless of where we were in our careers. And all of our fundamentals, all of our core beliefs and core values really aligned, because there is a human element to taking over these properties and operating them. And this allows us to kind of expand our business plan over the course of those 5 years and not just come in and just jack rents up as quickly as we possibly can. So our business plan being conservative allows us to do that. And that meant a lot to me coming into the team as well.
absolutely. I see the question about preferred returns. That's something that we're not doing. So on our deals, we're delivering the cash flow that is the cash flow to the investor. So we project it to be at 6%. Certainly if it's more, we'll do more, but there are no preferred returns.
We just feel like preferred returns, they kind of put us in an incentive they disincentivize us to hold the property longer, because we have different investors that have different expectations. Some prefer for longer term holds, some prefer for a quick exit, and that preferred return really incentivizes us to exit the property quicker than the market may want us to. And that's kind of where we were at on that. That's why we give the higher equity on the deal.
Thanks, John. This was kind of our 6-year projection. So we actually ran both, because at the time that we were raising capital, we really didn't know concretely which way we were going to go. So that's why you'll see a range. And then we provided both options for our potential investors to let them know it's going to be one or the other. And I think that was just an easy way to promote it and for them to get into the deal. So this doesn't really change much. You still see the same numbers on the 6-year sale. And then this is where I think this is like the key page when you're raising capital. If I give you 100K, what am I going to get back? When am I going to get it back? So we loved having this slide. It comes right out of the SDA. Right here, year one, it's showing your cash flow coming back to you, actual amount 5692, so a little less than 6%. Then you've got your year two, year three, year four. So your cash flow over the course of the 5 years at nearly 30,568. And then your actual percentage of profit at sale, the 87,000. So we're able to deliver an average annual return when you look at your profit plus your cash flow of 23.58%. That's huge to an investor who's got money sitting in a previous employer 401k plan or a CD, and they're typically making 5 to 6% average annual returns. And so excited about that. The cash on cash return was great to promote. And then there's a lot of people who are interested in looking for an IRR 17, 18 or higher. So that was something also to point out. And then again, we put out there the 6-year. If we were to do the 6-year, the loan assumption, these are what our returns would look like. And not too much different. So that was something that we had included in there as well. Interest rates. This kind of just speaks to the fact that buying or investing in multifamily, you're hedging against any interest rate increases. So that's just one of the things that we like to point out in our market overview slide.
Yeah, and this deck was put together about 3 months ago when the Fed was really talking up interest rate decreases over the course of 2024.
Love this. So talking about inflation rate, that's why we invest in multifamily. So if you are in a CD, I talk to investors about this all the time. If you're invested in the stock market, CDs, et cetera, you're typically making 6%. You've got inflation at 3%, fees at 1 to 2%. That leaves you at 1% or nothing. So you're essentially just throwing your money in a hole. It's not growing. What we see when we invest in multifamily with rent growth and appreciation and cash flow, and then on top of that, you're taking the bonus depreciation at 60%. That's exactly how you hedge against inflation. And then our market. So Charlotte is a great market, and we'll show you here in a couple slides. Since 2015, year over year over year, we see rent growth, we see employee growth, we see wage growth, and Atrium, Novant, those are our big hospital systems in the area. We're big banking hubs. We've got Wells Fargo, Wachovia, Bank of America, and then of course Duke Energy and additional manufacturers coming into the area. So we like to point this out. This is a growing market. We love the Carolinas, South Carolina and North Carolina. It's one of the top states that we're seeing people moving to. So looking forward to continuing to take assets down in these markets. And here's the slide that we love. So rent growth, population growth, home values, what's happening here. And you can just see year over year, we don't have any indication or any indicators showing that this is going to change in any way. So we see slow, steady growth year over year in all of our metrics that we look for when we're looking at assets. And then as far as location, that, like I said, that was really one of the points for this gem. I mean, the fact that it sits kind of in its own isolated little village-like setting, yet it is in such an urban area near universities, hospitals, shopping, the motor speedway. It's a direct link on a highway over to Lake Norman, which is a big boating area here in the area. And then you're about 25 minutes to the airport. So Charlotte Airport is an international airport. So it makes it a great location. The hospitals we may end up looking at doing, we're talking about with our property manager, corporate housing, or even housing for travel nurses in the area. And then comps. So when I tell you that we're 250 below market, like where did we come up with that? Well, we actually used comps that are within a 10-mile radius, actual rents in today's market. But then we also use other metrics such as CoStar, Rent-A-Meter, apartments.com, as well as just checking them out ourselves as though we're a renter and we're calling around to ensure that all the data is accurate and current. And that's pretty much a wrap up of our investor deck. At that point, it's just kind of explaining to our investors next steps, how to get involved, and we help them with that process. John and I have spent a lot of time building a relationship with a self-directed IRA company, as that's been one of our avenues for raising capital, and that has been great. I encourage you to do that as well as you're raising capital for your deals.
This is fantastic. We're going to take your questions here in a little while. I have a few questions also for you guys. Sandy and John, there's a partner. You have several partners. Sandy, what is your role? Now you're all active GPs, obviously, but what are you focusing on, Sandy?
So my focus is on investor relations. So raising capital, someone wants to get involved. They say, oh, I've got money in a 401k plan. So I'm going to help them get through the process of getting that money from JP Morgan, Fidelity, over to directed IRA and into the deal. A lot of that is weekly communication. I'll be putting together, we'll be doing monthly Zoom calls for our investors as far as updates go, newsletters, and then just, being a face to the deal. That's my thing. I love educating people on the powers of investing in real estate.
That's cool. John, what is your role in the GP?
Yeah, very, very similar to Sandy. I'm involved with investor relations as well. I also jump on all the core operator calls and discuss some of the unit turns and some of the construction that's going on as well. So work within the team and then communicate that to investors.
Yeah. So how do you guys? There's one question here in the chat. You have obviously 5 GPs and a KP. How do you maintain cohesive group dynamic and ensure alignment among everyone?
I think the biggest thing to that is the consistency of communication. So we have a core call once a week for all of us. John and I have our own core call once a week, and then we're communicating via text, chat, etc. throughout the week. So, and then of course the 3 main asset managers, operators they're communicating on a daily basis. So I think the consistent communication is what keeps this team grooving like it is.
I think that's
I would echo that consistent communication, but also having those conversations up front with the group, having very frank conversations about who we are as people. That is paramount to building a good relationship in a business environment.
Yeah, absolutely. Now, talk us a little bit how you kind of came into this partnership, because it sounds like you got into a group that had a few deals going, so you were able to leverage or track a little bit. Talk us a little bit how you got involved into this partnership.
So, Michael, you and I actually talked on Monday, and I was telling you, I think the power of being in a program like the DMM is networking. So really a lot of this was calls that we were setting up and just meeting people that were in the network, in the program, getting to know them. Like John said, what are their core values? Like, who are they as people? What are they trying to do? And once we found that those things aligned, it was like, great, we have a relationship. We kept that follow-up every couple weeks. And then when the deals came, it was kind of like we already had that established foundation. We didn't wait till we had a deal to start making those phone calls and having those conversations. So it feels weird to build a team when you don't have an asset.
Yeah.
But it's so important, I believe, to do that first instead of waiting to get your team together.
Yeah. When I asked the question, what's your biggest challenge? Aaron said, hey, biggest challenge is network and team building. Right. And so, okay, so how do you overcome that? How do you overcome the challenge of network and team building? Because clearly, like we talked about earlier, you need to have a network, because you're either doing one of those things. You're either really good at underwriting or deal finding or capital raising or investor relations, or you bring something to the table, and therefore, but how do you connect with that group? So how do you, what's the advice to Aaron to overcome his biggest challenge of network and team building?
For me, it's getting in those group calls, right? So you got to get in there. Even if you're not going to talk, put your video on just to kind of get over that. Eventually, you're going to start talking. Attending the mindset calls, that's a big thing. A lot of what's holding you back is your own mindset, feeling like you're not qualified to talk or feeling nervous or not sure what to say. And then reaching out to people and just telling them who you are. I think for me, that was the hardest thing. Like, why am I having a call with this person? Like, what am I supposed to say? And it was just more so like, I just want to know who you are. Let me tell you who I am. Who knows if we're going to collaborate? Might be a year from now, might be 6 months from now, but let's just say hi. And once you kind of start looking at it like that and set metrics for yourself. So my goal was 3 new interactions a day, people. That's 15 people a week, right? So that's great. And then set those up on biweekly communications. So before you know it, you built this huge network and you're maintaining that communication. What do you think, John?
Yeah, I would say, find a group, join a group, and be active. The last one is the one that people tend to struggle with. And once you get into those groups, you'll find, and Cody Bandura says this all the time, it's amazing how the ones that are active in the groups are the ones that are doing deals. I mean, if you're just sitting on the call, not not interacting with people, not being active, you're not going to do a deal. Get out of your shell and be active.
So I think that's the key to networking. Is I think a lot of people have this idea where you're networking with a goal in mind, some outcome in mind. What I'm hearing you guys say, and I agree, is that you're networking just to connect with people, because you never know where it's going to lead. You connect with people, yeah, you don't know where it's going to go. And now you connected with Brock and what was the other fellow's name? Ryan, I think, was the other person. And so I think Brock, I remember him because he's another student that did a deal, I think, a year or so ago. And so now you build a relationship with him, and you're like, oh, they're pretty cool guys. You know, they're pretty active, and you know, like, wow, we got this deal. Why don't you guys join us, right? And you made a good impression on them somehow. You didn't ask them for anything. You know, you're responsive. Maybe you were helpful. And I think that's the key for networking. You just build relationships with people without necessarily having an agenda.
That's exactly right. I mean, it is a business. I mean, we're all in it to start a career in this and continue a career in this rather than work 9 to 5. I mean, it is a business, so we all expect some returns at the end of the day, but it's just meeting people and just being open.
So let's talk about capital raising, because you guys didn't really talk about it too much. You talk about investor relations, but I know you guys raised money because you have the gift of gab, obviously. So therefore you can raise money. So what was that like? Maybe Sandy, go first. Maybe what was that like to raise money? Because I don't know if you've done it before. Maybe it was a new thing. What was it like? What did you have to deal with?
No, I hadn't done it. I've always done my own deals with my own money. And I just sold a 12-unit complex. And what I realized doing that all by myself is I didn't want to do that by myself. And the only way to scale is to do like syndication type format, which means you're going to have teams and you're going to have to raise money. So for me, I think it was just about sharing why I loved real estate investing, what it had done for me so far. It had allowed me to walk away from a W-2 that was a great paying job, right? That I'd done for 20 years, getting into multifamily. And so now I've got this great team and I'm working with them. And you know, people naturally want to hear what's exciting for you. Getting on other podcasts. So I think taking advantage of other platforms. There's so many podcasts that they want to hear what you're doing. What kind of deals are you looking at? So being open to that, getting involved with your local RIA, your real estate investor association. There's usually one in every area. Start going to those. I became the ambassador for recruitment for ours. So be open to just meeting people. You never know. Wholesalers, flippers, they're making good money. They're just not putting it somewhere. So this is a great option for them to be able to do that. And then the other thing is we've got so much at our fingertips as far as social media platforms. LinkedIn has been off the charts amazing for me building out my platform, my investor base, looking at people who have changed jobs in the last 6 months, using that certain filter that you can do in there. There's so many different things that you can do that put the people right in front of you that are your avatar or your ideal investor, right? So I think it's just locating who is your ideal investor and how do you get in front of them.
Well, I think it's a good point. You mentioned something about you just want to share your enthusiasm with people, and it's not like you're raising money, okay? Because now you have an agenda. You approach a person with the goal of raising money, and I think that puts you in a position of weakness, right? Because people can sense it. Versus like, let me tell you, I'm so excited about this apartment thing, and you share your enthusiasm, and they're like, really? You have a 6% cash on cash return and a 15% average or what plus, and tax benefits, and now they're leaning in because they're like, wait a minute, I'm not getting that in my current investments. And so now you find yourself educating, especially you talked about IRA investors, right? And IRA investors are happy to get 5.5% right now, right? And they're like, ooh, yeah, they're your favorite, you know? And you're like, oh, no, we can get you more. We can get you more than that. And they're like, really? Wow, that's amazing. Tell me more about that. John, I know is this kind of the first time you've started raising capital as well? What has that been like for you?
Actually, it's not. So I've been raising capital for 7 years.
Okay, cool.
Since I started in real estate, I started raising. I got the words of wisdom from some very good coaches in the flipping business.
Yeah.
Not investing my own capital in my deals. So I started raising capital for my own single family deals, rather than investing my own money into it. But I had set that up. I had set those relationships up for about a decade, but prior to doing that.
Yeah.
So being a vice president for the former company, I networked with some high net worth individuals, but it's different. So the challenge for me was converting these people from a 6 to 12% loan to a 6% cash on cash and a 20% AAR.
I had the same problem when I was flipping houses. It was 12% simple interest, 6-month turn, and we're like, oh, this was like shooting fish in a barrel. And then I was like, oh, I got this 12 unit, and it's with a 5-year lockup, and you're going to make more money, but you're not going to see your money for 5 years. And people was like, I'm out. It's like crazy.
That was one of the hardest things for me to overcome was the shift in mentality. But once I got that shit, once I started, I started to pave the path early on. So over the course of 2023, I started having the conversations with people about what I was doing to start to get that groundwork laid. And then the deal came up. And it was like, okay, now's the time to go. But once I started to get into it, I expanded my investor base by 3 times. Once I started going out, because I was doing single family deals, $200,000-$300,000 single family deals instead of a $6 million apartment complex. So it was a different challenge, but it was extremely fun to have those conversations, and I look forward to proving some of the skeptics wrong that have come into the deal, that have come into it and are still skeptical of the returns that, God willing, that they'll receive.
Right. We'll see, but certainly you've underwritten it. And we'll see. But let me challenge you both, because you both are experienced in your own right. Both, and I just find that the people that we attract in our environment are people who have done at least a single real estate transaction. They've flipped a house or they've rental property of some sort, and they're like, I wish I could do more of this stuff. I don't know how to do more of this stuff. And both of you have done single family house investing to a large degree. But let me ask you this, Sandy. Like, why did you, and you joined our mentoring program, you invested in yourself, and you said you used your own money to buy your own deals, but why in the world did you want to invest in yourself to kind of scale it up? Like, what benefit was that to you?
Man, I'll tell you, my first multifamily using my own money was buying a 12 unit, doing that on my own, and it needed to be stabilized. And so that meant that I have my broker's license, and I had a W-2, as I mentioned, and I'm a single mom. And so, stabilizing that property, overseeing the construction, getting the leases in there. I did travel nurses. I did long-term. It's not fun. I didn't find it. It was not fun. It was, and it was leading towards burnout. So I knew for me to continue on that path, it wasn't going to be sustainable. But I also believed in what I was seeing in my numbers, right? I proved force appreciation worked. I released up the building. I bought it for 1.3, sold it for 2.8, 16 months later. Like, the process works. It's just, I couldn't sustain doing that on my own. And I wasn't able to buy a 36, a 48, a 52 unit on my own. I needed partners, and I needed to be in a room with people that had like minds, because the people that I was around at that point, they thought I was kind of crazy. Like, you're buying an apartment complex? Like, what are you doing? Like, why would you even want to? It didn't make sense. So for me, it was both of those reasons. It made it sustainable, and it made it normal to be around other people who wanted to do this.
That's a good point. That's a good point, because you're surrounded by friends and family, and you're clearly crazy for wanting to do this. And the problem with that is, if you listen to it long enough, you kind of start believing it, which is a problem. And so, surrounding yourself with other people who are just as crazy as you are, like you've done now with John and Ryan and those guys, all crazy people, clearly. Now, John, for you, I mean, my fellow house flipper, as I was, I know why I kind of woke up, but it took me far too long after 3 dozen house flips. I'm like, oh, wait, something is wrong. That's not passive income. Like, what was a turning point for you?
I think the turning point for me was COVID. So I got into, rather than flipping, because flipping, good payday. You work as hard as you can, but it's not a payday that you can just sit back, right? So for me, I got into ground up construction through COVID. And that was a massive challenge in Southwest Florida. In the labor market dried up. It was very difficult to do stuff. So I've always been a very handy person. So I started doing stuff on my own. When I didn't see stuff getting done, you have to get stuff done. So I'm in 4 non-air conditioned homes in Florida in July after a hurricane setting cabinets. And that is not fun. So that kind of woke me up to, hey, I've got to make a change. I've got to figure out a different way of doing this to be active but passive at the same time. So I had a few other assets out of state, and they were paying me pretty well. So I was like, let's just scale this, and then apartments just it was just a natural change.
Yeah, I love that. So how can people connect with the two of you?
Oh, actually, we've got our website. They can go to vertexmf.com. And right there is our page, and they can set an appointment. They can reach out via email. Absolutely.
That's awesome. Yeah. So yeah, put in a chat. We'll put it in the show notes as well. And here's the thing. We kind of call Sandy and John our deal makers. Deal makers are people who kind of figured out how they can get a larger deal done much faster. And so if you want to do get a deal done much faster, then consider becoming a deal maker and working with us like Sandy and John have. So I just want to share with you guys, or if you want to explore that, let's have a conversation. And literally both Sandy and John at one point had a conversation with us. Just go to themichaelblank.com/clarity and just schedule a call. That's all. It's not a no obligation call. And what we want to do is we want to help you get clarity. Especially if you have done some real estate, you've done a flip or a rental or anything like that, and you want to scale that, kind of like Sandy and John have done, this is the perfect way to do it. It's really the only way to do it. Very few people become financially free with single family houses. I mean, and all of a sudden they do these things for a variety of years, like I did, like John did and Sandy, and finally we wake up and go, something ain't right? We got to do something. And then they switch to apartments, and boom, within a short period of time, they're able to quit their W-2, and now they're building generational wealth. So if that describes you, let's have a conversation. Just go to themichaelblank.com/clarity, and let's just have that call and explore what it's like to actually scale your real estate investing. So with that, I want to really thank both of you, Sandy and John, for being here on the show today, sharing your experience. It's been really amazing. I think one of the things that's really important is to work with someone more experienced, like you guys did. And I was one of the people who just kind of tried to do it myself, and it was tedious. I made a lot of mistakes. I didn't make a lot of money, and I kind of figured it out over time. But now we actually have a system that you can follow. It's called Dealmaker Blueprint. We have the right kind of support. We talked about the right community of crazy people, right? We have a community of mentors and experienced people that can help you, literally give you support on a live deal. And then we have the network. And I think that's really, hopefully, the one thing you'll learn here is you got to connect to the right network. And those are all the 3 things that we bring to the table to help you get into this game, not in years, but literally months. So hopefully you'll take us up in this opportunity to have a conversation with us. So head on over to michaelblank.com/clarity, and we'd love to have a chat with you. And with that, thank you again for both John and Sandy. Thanks so much for being on the show here today. And I'll see you guys next time.